Today's guest is no stranger to the most important side of any entrepreneurial venture, the money. Having worked as a private equity investor for over 25 years, he's founded 2 firms himself, as well as working with some of the biggest names in finance. So to teach us all about leadership through financial strength, please join me in welcoming Gregg Wilson to the Escape Your Limits podcast. Welcome, Gregg.
Thank you, Matthew. It's great to be here in sunny Southern California.
Yeah, beach view, you know, we're outside. What else could you want for?
I love it. I'm a Midwestern guy, so give me all of the sunshine I can get.
Yeah. So what are you doing in California?
I actually came to a concert. I brought my daughter out. We went to see the Jack White concert in Santa Barbara last night.
Oh, very nice.
It was great. Beautiful setting. Just beautiful. This is God's country out here.
So investing, you know, what made you get involved in that?
I don't know. I guess I've always, valued. I've valued the dollar, and growing up in a pretty humble household, and I initially got into banking, and I found that very interesting. You get to see all these different companies with different kinds of companies, different sizes, shapes, and as I got more into it, I realized that there's just enough distance between what the entrepreneur needs to tell you as a banker versus when you're the real partner of an entrepreneur. And I just said, I want to be a real partner because I grew up in a family-held business, and
right.
I kind of knew what that was like, and the challenges, the highs, the lows, and I just wanted to be part of that, but really on the finance side, the investing side, and it's, I've never looked back.
No. So I guess as an entrepreneur, I suppose like me, always that side of it is always the boring side, like the banks and the investors. It's always kind of like, the grey suit. And you're obviously not in a grey suit, which is quite, a little bit different. But what about that then? What kind of excites you about it? Where's the magic in it that I guess most people don't see?
That's a great question, Matthew, because actually what excites me about it, what maybe to you seems boring, it's actually, I have the most fun talking to people like you.
Right.
And I really love the stories because to me, it's really entrepreneurs like yourself that are the ones who have taken the real risks and have really done the biggest things. I mean, we're on the side. However, like I said, we like to be more than just a service provider. We like to be a true partner. And that's really my philosophy, that I have so much respect for you and people like yourself who are true entrepreneurs, that I decided, if I'm going to do investing, I want to do it as an entrepreneur.
Right, okay. And I guess money is the ultimate commodity, isn't it? I suppose it's...
Sure is. I've said that many times.
How does a business that lends people money separate themselves from another company?
Wow. Okay, I've got to try to keep this one short because this is where I can get on my pulpit and preach. So I'll keep it short. I've seen a lot of change in investing over my almost 40 years, 35, 40 years of doing this. And it started out that financial investors in private companies really didn't have to do much but come in and watch the pennies, really cut the costs, and cut out the fat, because a lot of these companies were spin-offs of larger companies and they were very inefficient. And frankly, the quality of the management wasn't that important, the growth rates weren't that important, and so the ability to get just tremendous returns on your money was back there in the 80s, even it started in the late 70s, 80s and into the 90s. But I saw that through my career changing, and I saw that more people came into the market, more supply of money, and it became harder and harder. And so, as a business guy, I said, well, wait a minute, we ask our entrepreneurs, what makes you different? What's your strategic plan? How do you differentiate yourself? But our own community, we were just giving money out and sort of sitting back and attending board meetings without any real strategy. So I said, that something's wrong here. So I said, we've really got to be different. And And if we are, we can be really at the upper echelon within our industry. And that differentiation today in the form of my firm Maxim comes through being a real partner with an entrepreneur. We aren't just a supplier of money. We're not just a supplier of money and someone who provides advice, but we actually step in and we really think of ourselves as really working side by side with the entrepreneur, not full-time. And in fact, having a part-time perspective is, I think, it gives us a different perspective than the entrepreneur who sometimes gets too deep in. I've had to run a couple of companies during my time, and I've seen the blinders come in. So we come in on this basis as a partner, both being a sounding board, trying to help you think through things that maybe you can't talk to with some of your own colleagues, and then at the same time we take on specific projects. And sure, I've gained a fair amount of experience in the industry, so have some others. That said, I'm mostly a finance guy, and we surround ourselves with operating executives in the industry, guys like Chris Clausen, who introduced the two of us, to really help us come in and provide the true value, because they have tremendous contacts and expertise that they can bring companies that tend to be relatively small but growing. And the thing they lack is resources, money, but also much more. They lack time and people resources, and we come in and really try to fill that gap.
Right. And how do you guys really focus on the sort of health, fitness, and wellness space? And if so, is it important? If you're looking for a partner to invest, how important is it to have someone that is fairly niche in terms of the categories that they focus on? So a two-part question there.
Sure. So again, I started as a generalist, and there are a lot of manufacturing companies that I was involved with, and I thought that was good because I didn't want to pigeonhole myself. But then as time went on, I saw the value of being focused. Then the question is, okay, well then how do you figure out what to focus on? And the initial thought, being a business guy and a finance guy, was, okay, well, what's the most attractive sector to invest in? And so we did some analysis and looking at various public companies and what kind of provided the best growth rates and return on investment and so forth. And that was one way to narrow. But that was when I was working for a large institution, investing with Bank of America. When I took a step away from that and really actually took a couple of years off, I really had time to think more about it and decided, that works, but also you got to really find an area that's personally you're passionate with. And I found myself at that phase in my life really finding wellness was a lot more important to me, education as well. And so those are the two sectors that we chose at Maxim. And they're areas I personally believe have changed my life and will continue to impact my life, the rest of my life. And I just believe if I can, make a small impact on others, not only can you do well, but you can do good at the same time.
Right.
And most importantly, I find that the entrepreneurs have tremendous passion. So if I have that same passion, it's a way to really connect and I think make that better partnership I was talking about.
Right. And talking about focus then, do you think on both the investment side and on the business side, sometimes, is there a danger to choose too much of a small niche or too much of a big category? Are both of those extremes potentially risky? What's your thoughts on that?
Yeah. As I mentioned, I started as a generalist, and I felt like if you just had some basic skills in business, you could help other businesses, and that was the case back in the 80s and 90s. But these days, there's so much sophistication at the entrepreneur level as well as at professional management level. And so the kind of help that we can provide outside of just good business skills that we think really differentiates us and can translate into a better investment for ourselves and our entrepreneurs, because they continue to be investors with us, are opportunities where we have a true knowledge of that sector through ourselves as well as through these executives that we surround the company with. They come out of the industry. I mean, an example, you're an international company, but if you're just say a US company and you're thinking about expanding internationally, never done it before, it's pretty daunting, especially if you're going to bankroll that yourself. We can bring in some talent that have been there and done it before and can help provide the confidence with that international experience. We obviously give some of the owners the ability to take some money off the table so they have more comfort in taking on the risk, and it ends up enabling us by being so focused to have a network of people we can bring in, as well as I mentioned our own knowledge, that we think we get better outcomes for our partners, our management and investor partners, and for our investors as well.
Right, okay. So in your early career, what were some of the interesting investments that you kind of made a good, I won't call it a gamble because I guess it's not a gamble, but you spotted and went on to be a success? And what was some of the thinking process in deciding, right, we're going to put our money on that one?
Well, there's one investment that I look at today and I say, oh my gosh, I can't believe I would have ever invested in that business. It turned out to be a success, however, and I credit that to a lot of hard work and a lot of luck. And let me tell you, don't let anyone fool you. There is luck involved with investing, and timing matters a tremendous amount. So this company, this was, 27 years ago. This company, it's called Acoustics Development Corp., was the leading manufacturer of pay telephone booths, if you can imagine that. Phone booths. Now, back then in the early 90s, the cell phone had come out, and more and more people were starting with cell phones, but there still were a lot of people who needed some place to go to make a phone call at an airport. And where you're from in the UK, you remember the red booths.
Yeah,
we call them
around.
Yeah, we call them the Superman style booths and so forth. They had already downsized. The reason for making the investment was it appeared to be very undermanaged, and they were coming off of a difficult year, and we thought we were getting a real good buy from a valuation standpoint. And it turned out to be a real struggle for about 3 or 4 or 5 years. We worked with probably 3 different banks, but we kept the most important thing, and I would really say this to any of the listeners or viewers, is you got to stay in the game. Find a way to survive and keep, if you believe in what you're doing, keep pushing forward. And we really had some great people on the team, and I realized that through that deal that it really comes down to the people. You can have great people in a bad industry and still do okay. You can have bad people in a good industry and you can lose everything. So we had good people, and we kept alive until our number 2 competitor, we were number 1, so number 2 came in and said, I've got to own it. And just happened to be they had a lot of money behind them that they had gotten from the .com boom, and they threw money at us, and we did very well with that. Right. So that one will always stick with me as being very memorable. You mentioned LA Fitness at the beginning of this. That one turned out when I was with CIBC Partners. I was a partner there to be, I believe, at the time, our most successful investment ever. It was a terrific success.
How big were they when you got involved?
Well, when we first looked at it, and I really have to credit my partners, because I was not the person who led the transaction. I was on the team and involved as a partner, but it turned out to be a terrific opportunity that started out at about 5 million of profitability on, I think there was 40 million. That was when we first looked at it and we took a pass. And then within 5 years, they'd gone from 5 million of profitability to something like 40, and the revenues had grown commensurately. And we said, okay, this looks like a terrific opportunity. Invested in a minority investment, and it turned out to be just an absolute winner. I believe LA Fitness, I've said this many times, is the world's most successful and fitness chain from a standpoint of its size and profitability. The two founders have done just a phenomenal job of making that into a very, very well-oiled machine, and have had to make some evolution over the years, but we're involved for 14 years. And again, it comes down to people. I mean, they started out as trainers, and they just knew what it took to make a club work. And in that case, this was pre-Maxim, we really were able to just, provide kind of consultation to them occasionally, but they really did everything for us. So sometimes, when you get really lucky, you can stand back and get back great people and do very, very well.
Yeah. What would you say is, a couple of the things, the ingredients that really made them outstanding? Because there's so many people in so many companies in the sector that I guess would love to, be fractionally as successful as what they are. What do you think are the things that kind of made them different from the rest of the pack, would you say?
Well, originally, they were one of the first chains that did not own the real estate. They leased the real estate, which is hard to do because most real estate for clubs is considered single purpose real estate. So it really is designed for a club, and it's hard to sublet it or re-let it if the club moves out, or and I'm talking about the larger size clubs, not the boutiques we see today. They were able to create a model that the real estate investors and developers were comfortable with, so they allowed the leasing. That significantly lowered the capital cost required to build out a given club. And it got to the point where in the early days, the club was able to generate enough profitability almost by the end of the first year from a run rate standpoint to cover the cost of investing, which is almost unheard of in any kind of a franchise model or a multi-unit type model across all kinds of industries. Now those economics have over the years dwindled because there's been a lot of competition that's come in, and of course clubs have evolved dramatically over the years. So that vision is more of a structure and a finance vision. But the other piece was the two owners were so steadfast in how they wanted every club to look and operate. They did not waver, and they didn't get distracted with, initially with like juice bars and various things. They stuck to the knitting. They're sort of like the Southwest Airlines of clubs in those days, and that focus was really key in building it out. But one needs to evolve over the years with the marketplace, and so LA Fitness has in fact evolved. But I'd say those were the two that really stood out.
Right, okay. And what do you think of some of the, you've obviously seen a lot of businesses in the sector and I guess look at lots of different proposals. What do you think are some of the things that people, one or two of the key things that people get wrong?
Get wrong in the club sector?
Yeah, we'll talk about the club sector for the moment, yeah.
Well, of course, it's changed a lot from what I've observed, and so I would say that would be the first thing, would be to not change with the consumer's behavior. For instance, what you do, functional fitness. That is an area that 5 years ago, very few clubs really even thought was going to be necessary. They still felt like you can get, all of a great workout with your typical cardio and strength equipment. But the consumer was saying something differently, as you know, with the CrossFits of the world. And so I think listening to the consumer, watching what's going on, and in our industry, there's this opportunity to really see what's going on with the boutiques. And so the larger clubs that are full service, I think really need to pay attention to that and evolve very carefully. We'll talk hopefully about what that means in the future, and I'm anxious I'd love to get your thoughts as well. I could share some of my own, but I think that's it. So I just described like the LA Fitness, which is stick to the knitting, but you can't be too rigid. You have to, I believe, just again focus on the consumer, evolve, try, be willing to invest and try. Don't risk the whole business by going into one direction. Try it, see how it works. If it's working in 1 unit or 2 units or so, some test units, then by all means you keep going further. And the last thing is, clubs, just like most businesses, they don't measure their results of the investments they make in their businesses through looking at metrics carefully. They sort of get a gut feel, yeah, this is working, this isn't, not, it doesn't. Sometimes the owners they have a notion, they just want to do it, it's going to work. That's because it's what they want, it's not what their customers want. Numbers don't lie. Yeah. If you measure the metrics and you see that it's paying off and people are actually using the equipment that you've just invested in, then by all means you're on the right track.
Yeah. Do you think there's a fine balance between the focus and the experiment? Because certainly, undeniably, the LA Fitness have got a good model, and I guess they're known as being very, they stick to the plan. And as an outsider, my perception is that's something that's really separated from everybody else, because they've not, fitness, I guess, is very trend. There's always something new, and right. I guess you could easily go from one idea to another without kind of really honing down your core offering. So would you say that that's a very delicate balance of staying focused and just saying, look, we're not going to, we're going to be blinkered, but keeping an eye on what's going on as well?
Absolutely. I think you have to know who your customer is. And I'm sure you would agree that every fitness club chain has a unique customer, and for the most part the customer probably fits into a certain profile. It's not always age, although age certainly can define, but it's a lot of what that customer wants to get out of the club experience, possibly whether they have kids and so forth. So if you know your customer and you know what that category is, how they're evolving in terms of their own fitness needs, I think will help you in their mind stick to the knitting. While you are evolving, you are still staying involved, very focused on just offering a certain array of services and not trying to be all things to all people.
Yeah, because I guess there's, particularly when you've got that number of clubs, if you do try something, it could become very expensive to experiment with anything, can't it, I guess? In terms of, if you put one thing in, you've got to do it 700 or how many times.
Absolutely, yes. Well, I mean, we know fitness equipment, it costs a lot of money.
Yeah.
And if it doesn't work, there's a ready market for others willing to take it, but at a huge discount. So that's not the direction you want to go. Yeah. And again, I say, if you have multiple locations, it's a great opportunity to just try and measure. If you try and measure and it works, then go for it.
You can go for it. Yeah. So what would be one of the sort of biggest missed opportunities, one that you thought, damn, I was going to do that and I didn't? Have you got any of those in your career?
Oh my gosh. I've got many of those. Well, one in the fitness industry is a company called Core Power Yoga.
Called what?
Core Power Yoga.
Core Power Yoga.
You probably have heard of them.
Right, yeah.
We met the owner of Core Power Yoga in, I believe, 2009. And at the time he was 30 units, I believe. and was looking for some capital to grow, to add more units. Not a large amount, $1.5 million, $2 million or so. And I had never done yoga, but I was in this phase where I was getting increasingly involved in fitness myself, and I certainly had heard a fair amount about yoga. And as we started researching yoga, maybe it was good that I hadn't been involved because I could look from the outside, at least at that point. I didn't have pre-biases. I saw that yoga was very fragmented, very much kind of came from its Asian roots, and the actual facilities themselves, it was not about the facility, it was about the yogi, the instructor. And that worked for, obviously for centuries. But there's this new group of fitness enthusiasts coming in who were used to having a little nicer environment. And so Core Power offered that nicer environment for people who, maybe were not in just this Zen-like experience, people that, had this unique view on the world. They wanted to broaden their attraction to people who are just looking for yoga as fitness. So we did offer, he ended up taking some capital from some local investors for each club, and who I'm sure required a lower ownership percentage. And it turned out, I think 5 years later, they sold for 10 times more than what we had valued the company at. And today is a great success. I mean, they're I think probably close to 125, 150 locations, and at least when we miss those, it's great to see them succeed as much as we're frustrated, because it does confirm that we were on the right track.
Right. Yeah. Wow. So you talk about luck, and I guess as an entrepreneur, wanting to be in control of your own destiny, like that word doesn't sit well. It seems as though you're not able to kind of influence. When you talk about luck, what do you mean, and how much of investing, what as a percentage is luck, and things going in the same way? Tell us a bit about that statement.
Yeah, that's a great question. So luck in the early years came from being in the right place at the right time, finding a pretty good business and having some pretty good people, and just not making stupid decisions. And if you happen to have those ingredients, which you could argue is luck or not, then you did very, very well. But the other piece that I've seen over the years that, and by the way, that's gone now, because those, that low-hanging fruit, the ripe fruit, is gone now from an investing standpoint. But there still is a luck in the business, in investing, whether it's public or private companies, and it really comes down to timing.
Right.
Timing of, is there going to be a recession around the corner? I mean, this industry does get impacted by recession, as much as I think we'd all like to admit it doesn't. I mean, we maybe have more time to work out when there's a recession, and you still have the passion, but some of the expenditures that go into, particularly I think some of these boutique clubs, where consumers may belong to 2 or 3 clubs, they'll probably cut that down and trade down, if you will. So who knows when a recession is going to come? I mean, I've been thinking for the last 2 years that we were due for one any time, because I've been through 4 or so, and I've seen the cycles, and it just feels like the cycle is upon us. But as we sit here today in August, it seems like the economy is still doing strong. So
do you think when you in terms of recession, do you think it's still likely to happen in the next couple of years?
I do.
You do.
And that's maybe because I'm just an old guy who has seen the cycles, and many times I've been in denial and said, no, things are going to be great, and then you get surprised and they come. So maybe now I'm actually too early and too conservative in anticipating it. But yeah, my bet would be that, sure, over the next 2 years we'll have a recession. I'm hoping it won't be as deep as the last one. And so I guess the way we deal with that is to say, that doesn't mean we shouldn't be investing. That just means that we need to be very careful and need to think through what's the impact going to be on a business and try to be involved with businesses that would have less of an impact. But if you are in a more volatile sector, timing can make all the difference. It can make you look really smart or really stupid. And that's why we try to stay out of volatile sectors. You know, fitness, nutrition, education, those are all going to be here every day. You know, those are basic needs in society as far as I'm concerned.
Yeah. And so when you use that word luck, then I guess does some of that come down to experience? So you talk about recession, and you've seen a number of recessions now, so your ability to anticipate the potential recession kind of mitigates you having to rely on luck. You could say, well, you know, I'm pretty sure it's going to come here. And I guess in the same way as seeing trends, you know, like you could see a boutique concept, maybe it's a little bit too early, maybe it's a little bit too late, but I guess if you know the category, it's probably less about luck than saying, well, I think it's going to happen, I just don't exactly know whether it's in the next 2, 3 or 5 years or something. Would you say that's more of an accurate description of it?
Absolutely. And if you go back to early when I talked about evolving from a generalist to a specialist, an industry specialist, one of the key reasons is to try to take luck out of the equation as much, and therefore take risk out of the equation as much as possible, and focus really only on businesses that we know and industries that we know. So we think while we're still going to be wrong, we feel like we're in a better position to make the right guess at timing and at trends in industries. And we talk to a lot of people like yourself. And frankly, that's where we learn everything. Because when we talk to 100 different entrepreneurs in the fitness sector, we learn a lot. Not every entrepreneur says the same thing, but we see patterns and we see trends. And generally when you find the most entrepreneurs talking about the same thing, it's probably there and it's probably going to happen.
Right, okay. So I'd like to ask you for your views on kind of what you think is coming down the line in terms of the industry. But what I'd like to do first is we put a few questions out on social media. We mentioned this was an interview that we'd been asked, several people had asked, can you get someone on to talk about this subject? So we've got a few questions from some of the people who listen to the podcast. So I'm going to go through those first, and then we'll get your views on the future of the industry. So the first thing then, finance for beginners. What's the difference between private equity and venture capital?
Thanks for asking that question, whoever asked it, because I know that there is a lot of confusion around that topic. So there's public equity, we all know the public markets, and there's private equity, which is basically anything that's not public, right? And that's how I always used to define it. And I thought of venture capital as being one segment of private equity. And that segment is investing in either startup companies or in very early stage businesses that generally are not profitable yet. They may be pre-revenue, they may be post-revenue, meaning that they are, they've generated revenues already, but they're generally still cash flow negative. So those companies need to get capital from people, from venture capitalists or from angel investors who are interested in taking a flyer on a young company with a management team that they believe in. And they're willing to go into those investments knowing that they may lose all of their money.
Right.
And that there's actually, that most likely they will lose all of their money. Now, let me tell you, many, especially angel investors, don't think that they will going into it because they have so much passion and belief. But that's what makes the world go round. They are excited about making investments and they're willing to take the consequences. But at the same time, when it works
right.
great. And Venture is not what my career has been built around. I have gone outside of private equity, which I'm involved with, and I'll define that a little bit more crisply, but I've gone outside of it a couple of times. I've fallen flat on my face and said, why do you ever do this? And on the other hand, really more just because a colleague of ours was leaving to start a business. I said, along with my other colleagues, said, sure, we'll put some money. We believe in you. We didn't really know a lot about the industry or the business he was getting involved with. And it's turned out to be the single most successful investment I've ever been involved with from a standpoint of the multiple of the money. So, Brad, if you're listening, thank you. I have so much respect for you and the fact that you were willing to step and take a risk in your life. So that's venture. It's
and that's
early.
Is that generally a high risk on both sides, and you're probably giving away a lot to get someone to take that kind of risk, would you say?
Yes.
Right.
So let me, but it's interesting, it may not always be giving up as much as perhaps should be given up. Let me help understand. I think it's always good to put some numbers. You know, I've already used the word metric. I'm a metric guy. Generally in venture, the venture capitalists are looking at an opportunity saying, can we make 10 times our money?
Right.
If we can't, grow by 10 times, then we really should be looking at another opportunity. Now they do that knowing that for every 10 investments they make, only 2 are going to be real successful. Maybe another 2 will be modestly successful. Maybe another 1 or 2 they get their money back, and the rest they lose all the money.
Right.
So it's not gambling, because there's a lot of thought behind it, a lot of research, and I have a lot of respect for the venture capitalists who are really good at this. So let me tell you about private equity, if I can contrast that from a metric standpoint. So first of all, private equity, as I mentioned, we're private companies, and venture capital should be a subsegment of that. Private equity really grew out of, originally there was venture and there were buyouts, which are private investors and investment firms buying private companies. And frankly, back 50 years ago, if you had a private company, it was hard to find someone to buy. So you hand it over to the next generation. But this industry of investment groups grew, and they were really called buyout groups, and they became the investors behind, or the option for entrepreneurs. So what has evolved, though, is that segment that's called buyouts has really broadened a bit to private equity, and it's separate from, in the definition, from venture. And it really incorporates buyouts, as I just described. And those buyouts could be of a mature company, or they could be of a growth company. And the buyout of a growth company often is where maybe the investor, the owner, and the founder is looking to take on a partner, but also is at a position in his career and age where it makes sense to have a cash out, but yet stay involved as an investor. So we may end up taking 60%, and that founder would have 40%, but our goal is jointly to grow the business. And again, I mentioned that 10 times, we like 10 times return as well, but we're looking for more like 3 to 5 times return on our capital, knowing that if we target 3 and have the opportunity for 5, that it should shake out into the 2 to 4 range on average, and that's very good in today's private equity market. It's down dramatically from where it was 10, 20, 30 years ago, but it's still good relative to investing in bonds and frankly a lot of the public company stocks.
And what sort of time period is that typically over?
3 to 7 years is what people in our industry tend to say most of the time. I think we're finding that the hold periods, they change depending upon the M&A market. Right now it's a very hot M&A market, and so a lot of transactions done 2 or 3 years ago, sometimes you're looking and saying, my gosh, I could get 2.5 or 3 times my money in 2 or 3 years. That's very good. But the typical analysis is done on 5 years, but if there is a recession at year 3 or 4, then guess what? It becomes 7 years.
Right. Yeah.
So that's what we tend to look at. Our firm, on the other hand, while we'll say 3 to 7, typically, we like, if you find a great business, why not stay with it for 10 years or 15 years? And frankly, at my previous firm, CIVC Partners, our biggest successes were those that we held for more than 10 years.
Right. And what are the type of multiples then that on the club side are typical people are getting? If they were to sell their business, what are you sort of seeing at the moment? I guess
that's a loaded question. They are all across the board.
Really?
It depends on a number of factors, Matthew. Size matters. We say that a lot, but in the M&A industry and in the club industry, size does matter, and it's because there's a lot of money out there. And frankly, as an investor, the bigger company you can invest in, frankly, it's easier to manage because you've got generally a deeper management team. You oftentimes have a little bit higher quality managers. You have more diversification of your customers. Maybe you have more locations. Maybe you're in multiple geographies, even internationally. So if one goes down, then the others can prop it up and you can survive and do fine. So the money really gets almost like sucked like a vortex to these large transactions.
Because I guess they're less risky, I suppose, aren't they?
Because they are less risky, but then what happens is that props up the multiples,
right,
which means the valuations to the investors go up. And as those valuations go up, the returns go down.
Right.
So it's this trade-off between risk and return. And so for large enterprises, and I'm talking, very, very large, the largest club chains of which, maybe they're a couple of handfuls worth, 1 or 2. If they're well managed and doing very well, very diversified, and have an upward trajectory, 9 times what we call EBITDA, earnings before interest, taxes, depreciation, allowances, to potentially 13 times. Now there are some public companies out there as well. It's been a while since I've looked at the public company comparables, but that's one way to sort of look at what the ceiling would be for a private transaction. You just say, well, what's the public? And it's usually going to be less for a private because you pay more for a public company because you can sell the stock the next day.
Right, okay.
And so a smaller one, however, if it's if you own a 5-unit chain and it's been flat for 5 years, and you're generating some decent profit but nothing spectacular, that can either be anywhere from very hard to sell to, if you do sell it, it's maybe 5 times, 6 times that profit number I mentioned, EBITDA.
Yeah.
So it can be literally half the multiple, maybe a third the multiple.
Right. And so for the smaller businesses then, what are some of the things that they could be looking to do? Is it a case of you would probably kind of do that in stages, go try and become a part of a bigger company and then sell in multiple times or something like that? Are there any strategies that they can be thinking about?
Sure. I think my recommendation first would be go back to some of the principles we talked about, is make sure that you're not all things to all people, and that you you know who your customer is, and try to make sure that if you have multiple units, hopefully you do, your units are all similar. So any investor or buyer going into one and then going into another one in a different state, different location, would see about the same thing, and a consumer would get the same experience. Because that shows that there is a model and it's working, and to anyone looking to buy it, they can then go replicate that model in other locations. So make sure that you're focused and that you've got a replicable model, number one. Beyond that, I would say look carefully at what you have invested in and make sure it's all working. And if you have a segment of your business that's losing money, try to be honest with yourself as to whether it's really going to turn around or not. Because if you can even sometimes just make the decision that we're going to get out of this business, or we're going to make this change to our business that will eliminate the money-losing operation, just that decision can oftentimes cause you to have that loss added back into your profits when the buyer's looking at the multiple. So those are just some basic things if you're just looking to sell your business to any party. As to selling to a strategic, that's a lot harder, but I don't think it's impossible. And part of that is you got to know the market, you got to know the industry. If you've got to understand where it's going, and you got to understand the key players and who's looking to grow, who's looking to make acquisitions. And you got to look very carefully at what are they looking to buy. And frankly, this is a very friendly industry. Being able to just get to know even the CEOs of some of these larger chains is not that hard. They're very open to talk, and just asking them, well, hey, I'd love to sell you sell my business to you someday. What are you looking for, and what would you most like my business to look like? And they'll probably tell you. And so that's the key, is you're building it for yourself and your customer base primarily, but also be mindful of what larger companies might be interested in as a way to bolt on your business to theirs, right, if that's something you're interested in. A lot of entrepreneurs have no interest in selling out to a big company because they know that inevitably the changes are going to be profound and it'll have a big impact on the people.
Yeah.
Could be good, oftentimes not.
Yeah. And what about on the other side then? So now with the industry changing as it is, there's a lot of opportunity for, I guess, someone who's been working in the facility to open up a smaller footprint studio, a lot lower cost than a big box. They might have a great idea, but probably struggle to get the finance to open that kind of concept. So what advice would you give to someone in that position where they, great idea, but they've got to put up money for lease, buy equipment, and to maybe open a few locations?
Well, first of all, make sure that you stay very good friends with your family, because you're going to need money. And it's really hard to get money to start new clubs and new businesses, period. And when you really go back and look at business startups, and when they go and get money in, that first round of money, we call it the seed money, oftentimes it's from friends and family. So just make sure you have lots of friends and you have, great relationships with your family, that they're willing to believe in you and put money behind you. So as simple as that sounds, that is the first source of capital. There's some interesting new evolving sources of capital. I think it's called crowdfunding. Again, it's not an area I'm involved with, but there are it's basically using social media to go out and post your business out openly into the web and say, hey, we're looking to raise some money. Would you like to put in some money? It could be $100, it could be $500, $1,000. And oftentimes there's some perks along with that. So hopefully you're in that works better in a business to consumer business, a B2C business. For instance, if you were in the wine industry, offering some perks, some special events that if you invest, you get invited to exclusive special events and so forth. A lot of people are willing to put money simply for that reason. I have a brother-in-law who's going to put some money into a new bourbon brand simply because he thinks it would be cool and he would like to be part of that. And so that's another source. Again, it's something that may not seem that obvious, but it is something you really need to think about. Beyond that, start forming some relationships with bankers early, even before they're willing to lend you money, because you want to be able to borrow money as early as your company will allow you to. And having those relationships makes a very big difference, because bankers, especially for small businesses, really they're lending as much on people as they are on businesses. There's also, the Small Business Administration. You can get SBA backing in the form of equity or loans. Now, a lot of times that requires a personal guarantee, and I would just encourage every entrepreneur to think very, very carefully before they personally guarantee. It's oftentimes an absolute requirement for your first loan, but make sure you really believe in what you're doing and you are 100% committed, because the worst thing would be to have something go wrong and see the bank have to come in and take everything away that you've built. Yeah. So those are the key options, and don't really bother going to the big or even medium-sized venture capitalists at the early phases of a business.
Yeah. Okay. What's if you are looking for an investor and you've got you meet all the right criteria, and you've got good business, how would you go about looking for a good partner? Because there's obviously loads of them. I guess you wouldn't just go on the internet, Google, and investment companies. But right. If you don't know anyone, where would you start that process of getting the right company for you?
Well, I would like to say, for my own selfish reasons, I'd like to say, go to the conferences and try to meet the investors that attend the conferences, because they really care about your industry, and they are going to presumably be a better partner because they're going to add more value. But that plays right into our theme of what my firm does. So that's not a bad way to go, and frankly, you'll learn a lot by going to the conferences if you don't go to already. But beyond that, speak to any lawyers that you know, accountants that you respect. Like I said, form relationships with bankers, ask them. And then, it used to be when I got into this business, it's like no one had an MBA in finance. No one really knew a lot about M&A. That was something they did in Wall Street and a little bit over here in Los Angeles and a little bit in Chicago, but everywhere else, people didn't really understand. That was just this mysterious world of mergers and acquisitions. Today, it seems like we're all either directly, we have a direct relative, or maybe we're one step removed from someone who is in that industry already. So just ask them and just say, hey, is this what you do? If not, then what would you recommend? Who would you recommend I talk to? There is such a massive number of merger and acquisition professionals out there that are really the ones that can help guide an entrepreneur through a selection of investors. And we work with a lot of M&A advisors. Sometimes they show the opportunities to a few too many investors in our view, because we wish they only showed it to us. But the good ones know how not to waste the entrepreneur's time. They get involved only the number of investors, prospective investors, that represent a good set of different kinds of investors to really enable the entrepreneur to select the best partner out of that group.
Yeah. And I guess the thing you said earlier as well is probably someone with a bit of a specialist knowledge in the category so that they can understand and I guess work on your behalf to say, well, look, this is what we know, probably more better picture, and as opposed to someone who's probably come from a different industry and doesn't really understand the details.
Well, again, I would say you're really finding a partner.
Right.
I mean, that's not much different than a marriage.
Yeah.
And there's a opportunity to date. It's usually from the time you sign a letter of intent to the time there's closing on the transaction. There's this heavy due diligence time. It's an opportunity to get to know your partner, and I would encourage you to make sure you spend that time, go to dinner, really get to know the partner, ask the partner a lot of questions, because they're going to ask you a lot of questions. So that is very important. Sorry, I lost my train of thought here.
That's fine. Yeah, just get to know who it is you're dealing with, I guess, is
yes.
the key thing on both sides.
Yes, exactly.
Yeah.
Right. Hopefully you can cut that piece there.
No worries. You'll make a note. So what are some of the, I guess, emerging trends that you see and people like yourself are looking at, keeping an eye on? And I suppose if you're in the business and you're thinking of where you personally invest, what are some of the trends or things happening that you think are going to be interesting for the next few years?
Are you speaking in the fitness industry specifically?
General fitness, wellness.
Okay.
It could be as broad as you want. But are there any areas that are yet to really take off? Like an obvious one, obviously, we're seeing boutique fitness is something that wasn't around a few years ago in the same way as it is now. So are there any sort of interesting categories that you think, this is worth looking at or getting in now whilst it's early? Sure.
Well, we focus generally on wellness, and so it is fitness and nutrition. I'll just make a quick comment about a recent investment we made earlier this year in a nutritional supplement provider for humans and also for pets, specifically for dogs. And this company, the reason why we invested is because they sell exclusively on e-commerce. And as we all know, the 800,000-pound gorilla of e-commerce is Amazon right now. So I think any theme involving e-commerce and Amazon is one that you should pay attention to. We found that among others that were investing, they didn't understand it that well. And as a result, the entrepreneurs running those kinds of companies found that they didn't have as many options for investment capital and partners that were comfortable making, becoming a partner in 100% e-commerce and heavily tied to Amazon. We did, and it's going very, very well right now, particularly with regard to pets. Right. So I don't know, maybe the future is pet fitness. There's got to be, maybe there's a pet fitness club in the future here. I know we are looking at a dog or pet hotel company right now. So it's really like, okay, is that different than a kennel? And it's like daycare. Yeah. It's daycare for your dogs. So that's a very good theme as well. And I'm sure fitness can work in there. With regard to fitness specifically, again, hindsight's so 20/20. I wish we could go back 10 years because we know so much now that's happened, specifically with the boutiques. I mean, the boutique clubs have just really captured the attention of the consumer and provided I think a terrific personalized, customized solution. And that's really around a class format, but you feel more of a community, it seems, than you do when you're part of a class, or at least a traditional class 10 years ago at one of the larger fitness clubs. So they also have been the most cutting edge in terms of what they've been offering. So I don't think boutique fitness chains are going away, even though I think that the large chains are doing a great job of now responding and offering a similar experience under the same umbrella of what a consumer often is already paying, but certainly within the four walls of where the consumer's been going, so the convenience is there.
And then, sorry, just on that,
yeah.
So from an investment perspective then, my guess, based on what you've said earlier, is that a sort of a bigger chain, bigger club generating more revenue that's got boutique in it is probably going to be more interesting to an investor than probably a sort of a mid-sized boutique, just because of the volume and potential returns. Would that be right? I know you can't ever say things are totally black and white, but is that a good rule?
Generally, I would agree. I would agree with that. That's a tough call, because
right.
There are some what you call like a mid-sized boutique with, what are you talking, 20 locations or so, 15, 20 locations. I guess it depends on how that boutique is evolving and what their offering is. If it's real narrow, I get a bit concerned. The boutique that I participate in the most is a spin boutique, Cycle Bar, and it's a very narrow offering. But right now, there are a lot of people who really like spin as a way to get their cardio, and it's rhythm cycling with the music. It's a great experience. It's a lot of fun. I'm absolutely the oldest person in the class all the time, but that's what keeps me young. So it's hard to say where a narrow segment like that one is going to be 10 years from now. And it's also one that can be replicated within a club. So probably what will happen, if I were a betting man, I guess I am, that's what I do, is spin will work in both a large club setting and in a boutique setting. It will be successful. But I think some of the boutiques that maybe will have more opportunity would be those that offer 2 or 3 different types of fitness, more of a total body workout. And of course there are a number of those there. It's gotten a little confusing because there's so many, and it's a little hard for the consumer to exactly know what it is until they go try it out. But I think there's going to be 1 or 2 that are going to emerge to become just almost household brands in that segment. So I would certainly watch that. I would watch the larger clubs that are, or I should say maybe even the medium-sized clubs that aspire to be larger, that are becoming a lot more nimble and offering a little more of a focused boutique-like setting, all under one roof, where they may have like 3 or 4 boutiques, right, or more under that one roof, while also offering some of the basic equipment and cardio and strength equipment that you have. The last thing is technology.
Right.
As you know, technology is really coming into the fitness world. I don't think it's been figured out yet.
Do you think that's what affected the valuation of something like Peloton, having that, because they've just got one location as far as I'm aware. Do you think that component is what made that the value of that so high?
Well, in all fairness, I do not have a Peloton bike. I, in fact, am awaiting my delivery of an alternative spin bike, and I plan at home, my wife and I in our home gym, to use streaming services on our laptop or tablet device right in front of us, that will give us the flexibility to choose the content that we want. If we want to participate in a class, just like in the Peloton, and we want to do it over and over, there's that opportunity. If we want to use I'm thinking of the DreamWorks, the animated, some of the really high-end animation. There's a company that does great animated workouts where you are there, really you're there in an animated form, biking with another group up a mountain on a Tour de France or whatever. So there are many different experiences that are available out there. There's more content coming. And so I think as the consumer becomes aware of all these fantastic experiences, I believe that the consumer is going to ultimately want a little more of a variety. Now that said, I think Peloton will be successful. I personally think they're probably overvalued. It's still a private company, but from what I've heard, some of the valuations are just off the chart. I think their success is not necessarily demonstrated in terms of profitability, although I have not seen the numbers, I don't know. But it's success in terms of the awareness and the brand building that they've built. They've done, bar none, probably the best job of anyone. And by building a good brand, that's instilled a lot of confidence in the investors, and that's why I believe the valuation is as strong as it is. But that's home gym, if you think about it, which has not been a growing category as much as going to the boutiques. So I hand it
seems to
have
have died. Well, I guess home fitness used to be huge, I guess mainly through the big box retail, and
that's right.
With that changing, I suppose it's in a bit of a strange place, isn't it?
It really is. Will it come back in a strong way? Again, I think it will. I think technology will make one feel like they're more of a community. They can actually participate in a class and even get to know some of the other fellow classmates, maybe just by name, but because they attend the same class, even though they're at home, virtually. So I think there's a lot of that experience that will come, and so I think home will have its time back. But technology is exciting. I mean, it's not sorted out in the industry yet. We know it's coming. A lot of people are trying different types of technology in clubs. As an investor, again, we tend to wait until companies are profitable and already reached a pretty decent size, maybe 5 million to 10 million in revenues. So we're not as involved in that real cutting edge and early stage, which I would call, that's a little more betting and gambling in what's going on today. But it's exciting, and there will be some real winners.
Right, okay. So final question then. So Escape Your Limits is about escaping what you've believed is impossible or other people have told you is impossible. Is there an example in your own personal career where you've escaped your limits and done something, maybe made an investment that people probably said, well, maybe that's not possible, it's not going to work, and yet it did?
I certainly have found myself trying to push the edge of the envelope on the investment side. It's a very traditional community, and it should be, because there's a lot of risk involved. So investors are comfortable investing in what they've invested in the past that's worked for them. When you try something new, while it may on paper seem to have a lot of opportunity, there's just a lot of fear of the unknown. And so as I've evolved and our firm has evolved in our thinking about investing, we are increasingly looking for opportunities to find sectors that are demonstrated to be successful, but haven't been successful for years and years and years. And so it really takes a lot of the investment community out of the equation, because they're still, they're more in a, well, you got to prove it to me a little bit longer. Probably the one that comes to mind is the investment that we just made earlier this year, as I mentioned, in this nutritional supplement company that sells predominantly on Amazon, but on a few other platforms. I mean, here you effectively think of it, oh, this is customer concentration, 80, 90% to one customer, Amazon. Is Amazon really the customer? Or if you're buying and I'm buying on Amazon, are we the customer? That's, I guess, a key question in terms of trying to understand it. It's difficult. But that has, so far, we have a long way to go to finish out the investment, but it is really proving out that, first of all, we know we have wind at our back in nutrition and wellness generally. I mean, let's face it, we increasingly see that while our community still has a lot of huge issues with wellness, and unfortunately it seems like increasingly, there also seems to be a much larger and a growing sector of people, used to be very small, who really focused on and cared about wellness, and we're trying to spread the word. That group keeps growing. So I think we're going from the unwell over here, and then and they're growing, and then the people who are super into wellness, whether it's fitness, nutrition, they're growing. It's the indifferent group in between that is becoming less indifferent, and I believe that they are taking on more and more wellness traits, and because they're exposed to it. They go to a Kroger now, and there's organic section, and we see it all around us. So that's a great thing. So if you have wind at your back, it can, I think, give you the confidence to maybe take some risks that haven't been tried and true, like, again, betting on an 800-pound gorilla like an Amazon platform. But that said, our strategy there is, our number one goal is we need to diversify away from Amazon. Can we get it down to 60%? I think we can, but it's going to take a lot of work because they just keep growing.
Yeah.
So that is, I think, a good example, and a little behind the philosophy, I think, that we think of in terms of kind of stretching out. I would just urge everyone, if you're thinking about investing, just be cautious when when there's a new kid in town and it just looks like the greatest thing since sliced bread, as we used to say, and it can't fail. Just be careful, because more often they will fail than they won't. So make sure you have a few, make sure you've had 2 or 3 failures already happen and 5 or 6 successes. And then if you have that environment, then it still's pretty early and you're probably going to do very well.
Yeah. So are you, if people are interested and have questions about buying, selling, investing, are you open for people to sort of contact you in any way at all?
Absolutely.
So how will people find you?
Especially if it has to do with fitness, nutrition, wellness, education, anything. Just, I could talk all day to anyone who wants to about those topics. I have such a passion. So yes, reach out.
Do you have a website or?
Yeah, our website, www.maximpartnersllc.com. You can reach me directly, Gregg, with, I like to say 3 G's, 2 at the end, at maximpartnersllc.com.
Okay.
And
are you on LinkedIn?
LinkedIn, you can find me on LinkedIn, and myself or my colleagues would love to talk to you and answer any questions and help out. That's really what it's all about in business and in life, is you help other people and they'll help you.
Yeah. So Gregg, we didn't get through everything. There's probably a part 2 on the cards at some point to see if your predictions are right. But appreciate your time. There's some fantastic information there. So anyone who's looking at sort of investing, buying, selling a business, I think there's some really good tips that you can take away and apply in your business. And hopefully the people who have sent the questions through, we've been able to answer some of those as well. So thanks again, appreciate your time, and best of luck with everything.
Well, thank you, Matthew, and I'm looking at a bunch of fitness equipment here. Maybe we should do a workout now.
Yeah.
Okay, thanks.
All right, thank you. Thanks.
Great.
Hey, I hope you enjoyed this podcast. If you did, then please go over to iTunes and subscribe to the Escape Your Limits podcast. Leave a review, leave a comment. It really would help us a lot to continue to keep these going.